Laura Delvis.
Korean Creek. In case you guys didn't get it earlier, I'm Joey.
And we're going to present the company Intel. So Intel is the #1 manufacturing company for processors. Its founders are Gordon Moore and Robert Noyce, and its CEO is Bob Swan. Intel's company is currently worth $253 billion. Intel is currently coming out with many new projects that will help them increase their revenue. One future project is that Intel will be partaking in a new mobile PC platform with Ice Lake. Ice Lake is Intel's codename for the 10th generation Intel Core processors based on the new Sunny Micro architecture. Intel's PC revenue has been down 5%, but due to Intel expecting a total of 30 new designs to launch by the end of 2019, their revenue is projected to be at $19.2 billion with a 3% further growth. Another future project Intel is going to release is called Project Athena. Project Athena will help Intel accelerate laptop innovation by combining world-class performance and improving battery life, as well as featuring new and improved designs. And lastly, Intel is also expanding its 9th Gel Core desktop family.
Alright, so let's jump back into it. Let's talk about growth rates. Our revenue increased by 12.8% from 2018 to 2019. So we just decided to continue growth at a declining 2% rate per year, which gives us 10%, 8, 6, and 4% growth rate in 2022, and at a terminal growth rate of 2% at 2023 with 94,641 million of revenue. Our dividend discount model starts with a dividend of $1.2, and the growth starts at 10% annually, then goes down 2% annually to a terminal rate of 2%. We calculated the debt to be 26% and equity to be 74%. We got those numbers from the Intel income statement. Our cost of debt was 1.78% calculated through interest expense over total debt. And then our cost of equity was 8.45%. The capital structure consists of 0% preferred stock, and then the new tax rate due to President Trump's new laws, I guess, is 21% for next year. The risk-free rate is 1.94%, which is a 10-year T-bill. Our beta was 0.93. We got that. That's a 5-year beta. We got that from Morningstar. And then our market risk premium was a 7%. Our terminal growth rate is 2%, gives us a terminal value of 28.71. With all year dividends accounted, the value of Intel was $33.66, and that is through the dividend discount model. The current stock price is actually $58.35 right now, so our assumptions are assuming a 42% decrease in Intel stock price. The dividend discount model urges us to sell the stock, but as we will discuss further, that's not the model that we're going to use to give our conclusion. For scenario analysis, we actually calculated the unlevered beta, which is the beta at 0% debt. And then we got the cost of equity to be 7.03%, the cost of debt to be 0%, at unlevered beta there is no debt. And our after-tax cost of debt is probably 0%, and our weighted average cost of capital was 7.029%. We used this analysis to calculate the beta and the WACC and the cost of debt and equity for different capital structures. Currently, Intel is using 26% debt capital structure and 74%, which gives us a WACC of 6.609%. However, the optimal capital structure, if Intel the WACC is minimized at a debt ratio of 28%, opposed to what they have right now at 27%.
Next, we're going to talk about the market multiple method. This method essentially takes data of different companies and sees how our company does within the industry. Our first step was to identify different competitors like that can like differentiate within Intel. Our second step was to compare using a marketing metric, and now Joey's gonna talk about our calculations.
Okay, so I need you guys to do me a favor and don't look at the slides right now, okay? Because there's a ton of numbers, alright? So look at me and I'll take you guys through it. So these are the numbers we got. We got the earnings per share for the trailing 12 months. We use that to calculate a sort of intrinsic value for the stock right now by calculating it with the PE ratio for all of the competitors that are listed along here, alright? So here's all the numbers for the price for free cash flows, price for cash flows. We use the PE ratio. Here's the trailing 12 months I was just talking about, and we also decided to kind of forecast the valuation of the stock by using the earnings per share for the next year. That was an estimate. So with these numbers, we got a lot of variability, which is why I'll go into that more later. And the data, by the way, comes from FinViz. So we calculated the averages as well. We can ignore this and we can go straight into the most important things about this marketing multiple method. Basically, the intrinsic value for the Intel stock by using this method is 58.24. Now, other stocks within the industry are valued much higher as an average, which is $120. That's the average intrinsic value for the other stocks. The median is 92.60 for these other stocks. The reason the median is going to be more accurate in these cases is because there's a super big outlier. Actually, there's two, NVDA and AMD. So that's why the median is a little bit more accurate. And then we looked at the rate, because these numbers don't really mean anything. There you go. So this is the actual comparison of the intrinsic value that we calculated and the stock's actual price. So according to this method, the competition, the median is that the intrinsic values of the stocks are a little bit lower than the actual price. So that's through the median, and then with the outlier, because one of the stocks is apparently 26.60% rated lower than actually like the market value. So ignore that and go for the median. So it's basically, this method said that like nothing's going to change intrinsically, or the intrinsic value is like not much different than the market value. And then when we did the forecast of stock price, there we go. So this is when we used the earnings per share for the next year, and we multiplied it by the PE ratio. We found that competition had an average stock price of $279.18, while the median was $182.41, while Intel was slightly higher at $63.84, and as we saw today, the stock price closed around $58. And then so this once again means nothing, but when we look at the growth rate, it's saying that the competition next year is going to grow an average of 133%. So, like, I don't trust it, we don't trust it. We think that it's way too high in numbers. The variability is just extreme. And a company like AMD says it's going to grow 440% next year, and if that was the case, then we'd all be buying AMD right now. So, just comparing the quick industry averages with other like objective data we got from FinViz or whatever, the free cash flows for Intel is very comparable to the averages of other companies within its industry, as well as the PE ratio, as long as the price for cash flows, but the PE ratio is extremely low for Intel compared to the competition. So, the overall marketing multiple method, what we found from doing this, is that the competitors are apparently super overvalued, or actually slightly overvalued, and then they will apparently grow by an extreme amount, which is unrealistic. So now we're going to get into discounted cash flows model. Yeah, did you want that after slide or no? You can't anything else right now. Go out there, they're used to this.
Okay, so I'm going to start talking about the discounted cash flow model using free cash flow. So basically, this is the main model that we believe is the most, the best one to determine the intrinsic value of price per share. And we say that because for the dividend cash flow model, as you remember, we got a price of $33.66, and the current price right now is about $58. So the difference between them was significant, and we believe that is not a reasonable price. So we then looked at the, as Joey explained, the market multiple method. And with this one, we also saw variations between when we used the EPS, the estimated EPS, we saw that the numbers were inconsistent and unrealistic for the most part. And we also felt like that the this kind of cash flow model was more complex in general, and what I mean by that is that there was more factors that we put into it, such as growth rate, we use WACC, the payout ratio, CapEx, and we also use the financials of the company, such as the balance sheet, the income statement, and the free cash flows. So the intrinsic price per share was reasonable based on the direction we felt that the company was heading towards. And the growth rates reflected a positive correlation between the intrinsic value that we got. And we also expected Intel to reinvest a lot of the money that they were getting based off their retention ratio, because their retention ratio was like 73%. I'll show the number in the next slide. So first, I'm gonna talk about exactly what we did in the dividend discount model. So for the historical data, we used the previous 5 years, and we got that from Intel's website of their investors relations. And with that, we used the 5 previous years to get the income statement, the balance sheet, and the cash flow statement. And we plugged all those numbers into our Excel file. And following from that, we used that to forecast the year for 2019 using the values from 2018. And in order to do that, we needed to use our growth rate, which we determined was 10%, and that was for the first year. And following that, the growth rate was reduced by 2% each year until we reached a terminal growth rate at the 5th year, which was 2%. And the retention ratio was 73.6%. And the retention ratio was basically the money that the company retained after net income. They multiplied the retention ratio, and that's what they reinvested back into the company. And after we calculate those values, we also have to calculate the rest of the values for the following data in the 2019. And once we get all those numbers, we use those to determine the additional funds needed equation. And in our first pass, we got a negative number, which was negative $8,811,000,000. And since it was a negative number, we had to add that number back into the assets in order to balance out the additional funds needed equation. And I asked myself the question as to why we need to add the excess cash back into the company. And I determined that based off the retention ratio, it made a significant difference in which 14,009,025 was retained and invested back into the company for upcoming projects. And on the other hand, if AFN was positive, that would mean that we would basically have to add that money back into the debt, into long-term debt, and the way we can do this is by issuing bonds. But we all know that if we increase debt in the company, there's always going to be a consequence in which sometimes we might raise risk in the company. So using the same retention ratio for all the forecasted years, it kept on making the numbers in the AFN negative, so meaning that we had to add back our values back into our assets. And these were the numbers that we got during our first pass for each year. So if we look at 2019, we got a negative number, and it goes all the way down all the way to 2023. But in the second pass, we had to balance it out, and we ended up fixing that. So again, I felt like the high retention ratio played a big role in the increase in retained earnings in the company, which is why we had a bunch of negative numbers. And now, Linnell will talk about the free cash flow.
So regarding the free cash flow, we calculated the NPV of the present value of free cash flow as well as the terminal value, and this gave us a total enterprise value of $338,790.79. To calculate the value of equity, we followed up by adding the cash and by subtracting debt, which gave us an equity value of $288,324.79. After finding the equity, we then divided that number by diluted shares outstanding, and this gives us an intrinsic value of $61.33. The price per share was $58.35 yesterday when the market had closed, but the current price as of right now is $57.90. Using the information, we determined that the current stock price is slightly undervalued, meaning our intrinsic value and as provided in the chart, the intrinsic value is $61.33 per share. Given that the stock is currently trading at $58.35 per share, which is below our calculated intrinsic value, and this indicates that we found a bargain. Therefore, we will need further research in order to determine whether we should move forward with actually purchasing the stock.
Here, I'm going to go over complete what if scenario. So this is our scenario. So as all of us do, we pay taxes. Those are the corporates. So this sensitivity analysis refers to the increase and decrease of taxes, but not just any slight increase or decrease, historical increase and decrease. So here we have our most likely, which refers to our current standing of corporate tax rate, which is 21%. As Rafael said, our intrinsic value, which is what we're looking at, is 61.33. So the historical past is back, I believe, in 1910 when corporate tax rate were at 1%. It was actually possible. Actually happened. But in that case, the intrinsic value to get the part or corporate tax is 52. So then you notice that the price goes down to 19%. So what this means is that the tax has an inverse effect or change in the value per share. So it's not to, so the purpose of it is not to see what if taxes go all the way down 1% all the way to 10%. So to see if there was a small change to taxes. You have a general idea that it will most likely go up. If it goes down, it will slightly down in relation to the tax rate. So we're concluding whether it's buy, hold, or sell. So as you heard from Ralph, we went with our discounted cash flow. That discounted cash flow because the market multiple method had too many variations with NVIDIA and AMD, and then dividend discount model seemed very unrealistic, with I believe a 32% difference. So it just seemed too unrealistic for such a drastic change. So we would recommend to hold the stocks if you already hold stocks, and probably not invest right now just because it's around a rate of 4% premium. So not a great time. Not a great time to sell or buy. So thank you for listening to our presentation. We will now take any questions from the audience.
When you mentioned the corporate tax rate at 53%, when was it 53%? I don't think you went over that.
In 1968.
1960.
Yeah.
Okay.
I just want to fact check that, so you can Like
Yeah,
that,
so
figure
our
it out
research
together.
came from the United States Federal Corporate Rate Tax website, so it has a huge range, you have to pick one. Yeah.
I forgot what slide it was. It was mentioned like the declining growth rate going like 2%
Yeah.
each year. Was that like you selected that, should you made that choice?
So for 2017, from 2017 to 2018, the growth rate, the company grew by 12%, and then for the next year, it grew by 10%, so we just kept the same.
So do you think that's like come 2024, is it gonna go to 0%? Was that?
No, because our terminal growth rate was 2%, so what terminal means is that it's the constant growth rate at the end of the model. So by, after 2023, 2024 is gonna be 2%, 2025 is gonna be 2%, this all the way up.
For the comp analysis, why did you choose to get an average of the market as opposed to a direct competitor?
Well, we have direct competitors as well, but we figured that the average of the market was more important. We actually have each number right here, I just didn't want to be going to every single company.
So was your intrinsic value based off the average or a direct competitor?
Through the information that you can see right here and the information that we can see right here.
Yeah, what was the comparison, the market average or the direct competitor?